targets and stops. This came from my trading diary. Basically what I try to do in all my trades, I try to buy below value, and this was a very short day trade, daily chart, 25-minute chart. I bought, I held it for 3 days, and I saw a divergence on a 25-minute chart, and I sold it out. Bought below value, bought a bullish divergence, sold above value. What's wrong with this picture? Not too much. Short, little, neat swing trade. This is the stock I shorted the day after our workshop in Alabama. False upside breakout, missing right shoulder diversions, short, didn't cover here because it was very bearish on the markets, and covered really very low. Covered when it went below the lower channel line, started reversing. But basically, my targets are always off of channels and moving averages. I want to buy below value. I want to sell short above value. If we go back for a minute to that IWM trade, we will be released to sell short at 117.05. The moving average is at 116.87. So if I don't grab it above 116.87, I ain't shorting that thing, right? And it's not actually the greatest short even now because it's so close to value, but it's legal. So I want to sell short above value. I want to buy below value. And as far as profit targets are concerned, I think a channel is a wonderful profit target. Right? So that's targets. Let's talk about stops. I already said to you that to me a dumb stop would be below the lowest low. So here, leg comes on down, establishes a low, we put a stop below it. Well, what do you think happened here? You know, the pros know that there are stop orders sitting there, and they just push the market there a bit. And that's why time after time after time, you see how this is the bar at which all the stops, all the easy stops get wiped out. Anybody who bought and put a stop below the 1 cent below the low got taken out here at the worst possible time. That's why I keep saying you want to place your stops outside of the zone of market noise, outside of the zone where the market just goes like that. And lately, I've been using extensively this one tool for placing stops. And that tool is average true range. It's included in every software package that I know of, ATR. Here is this chart of this IWM thing with ATR channels, 1, 2, 3. So what's the distance between those channel lines? The distance is 1 ATR, 1 average true range. So what is 1 ATR in IWM? It's 111.76 to 113. So 1 ATR is close to a 1.5. It's close to a 1.5. So if we are going to put our stop within a 1.5 of the price, we're asking to be hit. So this $1 stop that looked so nice on the charts is probably not such a good idea anymore. I place my stops at least 1.5 ATRs from my entry. So 1 ATR is what happens during the day. So at least 1.5. And 2 ATRs is even better. Man, this IWM looks so sweet on this chart. Rally, break, and this missing right shoulder. Break, and it's holding. Well, maybe it wants to do another run to the top before falling. But putting a stop at $1 away suddenly doesn't sound so good anymore. 250 would be more like it. 3 maybe, 250. So if we put a stop at not 117.05, but at 118.05. Where will it be? Approximately here. Yeah, makes sense. So what does it mean if we put a stop that wide? If we decided to risk only $250, we now should trade only 100 shares of this thing. And that's, yes?
When a lot of protected stops are put at the same level, and then all of a sudden, say the stock dips to that price and knocks out all those stops and then it goes up, who's causing that dip? Market makers or brokers, or who's doing that?
It's a good question. I was trying to think how to give a short answer to it. Let me preface it by saying I'm no believer in conspiracy theories. I don't think that there is some kind of cabal of traders watching your stop and planning how to hit it. But these guys who've been doing it for many years, they know that stops are there. They know because, first of all, they see it on the charts, and second of all, some of the quote systems show you how many orders are stacked up. Even if you don't place your order, they still see those chart patterns. Stops are sitting.
Who's seeing it? Institutional traders, or who's the one that's seeing that?
We can see it.
You can see it.
Yeah, but I can't knock them out myself.
You can't knock them out, but you can see them. You can see those stops. Okay. So those guys, it's not that they're knocking them out. They see those stops. So now suddenly there's a little swing and prices start declining. And under other circumstances, those guys, they buy weakness, they sell strengths. But they're close to the stop level. So they say, you know what, this thing might very well go all the way down. Let us pull back and not buy. And it becomes a self-fulfilling prophecy, because these guys see that stops are close. They're not buying because they know that so many times the thing falls all the way down. So buyers pull back, sellers are there as usual, the balance shifts, the stock accelerates down. The stock accelerates down, it hits the stops. Now it's flying down. And now those guys are sitting with their fingers above the keyboard. It flies slower and slower. There's a sale going on. There's a sale. Buy on sale, yeah. So I don't think that it's like there is some kind of conspiracy to do that. It's just these guys see support level is approaching, they stop buying. That's when the volume stops coming in, yeah. Instead of worrying sick about those super fast algo traders, they're chasing pennies basically at a very fast speed. They're trying to grab a very fast penny, if that much. Well, is that what you're trying to do? Are you trying to sell short IWM and make a penny? Well, if that's the goal, then you're really competing with those guys. But if you plan to get in and do a swing trade that will last you maybe a week, well, you're in a completely different game. You're in a different ballpark. And what those guys are doing, they're just bringing more liquidity for your benefit. Use limit orders, longer term planning limit orders. And that's the answer as far as I can see.